Well, it's been a rough start to 2016. I'm not going to lie to you about that. However, I like to take this time to always talk to my clients and reiterate a lot of the issues that we are concerned about. And one of them is an important law that you have to understand as an investor. That law is time in the market that builds returns, not timing the market that builds returns. Listen, I've been in this business a long time and it never seems to fail. That during times where the market get a little bit wobbly, there's nothing short of financial advisors going straight to the panic door. So much junk and nonsense is being spewed on TV and radio. All these experts talking about timing the market. It's junk. One of the things you have to understand, if financial advisors knew how to time the market, how come you never hear of financial advisors winning the Powerball lottery? It doesn't happen, okay? You must understand that market timing is nothing more than playing Russian roulette with two bullets. The idea that some person is going to save you from any market downturns while at the same time giving you the upside of the market is nothing but a great fantasy. Let me give you something that I teach in my classes and to kind of give you a little bit of perspective. If 70 years ago you would have invested $1,000 in a savings account, that same $1,000 would have grown to now approximately about $16,000, $17,000. However, if you would have taken that same $1,000 70 years ago and invested in the S&P 500 over the stretch of time, the last 70 years, it would have grown to roughly about $1.8, $1.9 million. If you would have even invested in a little bit broader portfolio of 3,000 stocks versus 500 stocks, your portfolio would have grown to close to $13.4 million. Now, over that span of 30 years, I'm sure there was a lot of volatile periods, but I'm sure you wouldn't have been disappointed with either $2 million or $13.4 million. Now, let's take a look at market timing and the fallacies of market timing, okay? One of the things you have to understand, however, if you time the market, if you took that same money and timed the market perfectly, you timed every bull market, selling at the top, buying at the bottom, and selling at the top of every bull market, that same $1,000 would have grown to $7.2 billion. However, conversely, if you would have done the opposite, you would have timed everything wrong. You would have had approximately about $3, which is enough for you to buy a cup of coffee, not even at Starbucks. So this is what you need to know. Okay, no one can reliably predict market movements, and that includes experts whose job is to do so. All right, the Stock Pickers Hall of Shame is a very crowded place. So what should you do now? Well, if you're a saver, if you're one of our clients and you're a saver, well, we're going to put more money in, because understand that markets always revert back to the averages. So in a negative year, your money is going to buy more shares, and therefore that money is going to have expected higher returns going forward. Number two, we want to convert. And this is something that we actually do every year, where we take opportunities like this and convert taxable money or taxable income, future taxable income into future tax-free income stream by using Roth IRAs. Okay, so we convert traditional 401k or traditional IRAs to Roth IRAs or Roth 401ks. We do that every year. So to some people we can't, because it's dependent on some variables. Number three is we want to rebalance. Now, we do this automatically, and you know this, okay? This is when we buy low and sell high. This is the autopilot we have in our portfolios, and we're going to do that anyways. Number four is to review. This is another thing we do during tax season with our clients, is that we sit down and review where we are. And number five, and most importantly, is you need to remain disciplined and know that you have a plan. Listen, there is not one retired client that we have that is dependent on the market in order for them to maintain a lifestyle. Okay? That's because we take advantage of guaranteed income streams to pay your bills, not volatile income streams that come from the market. So understand that the components you have in your plan and why they're there. So If after all these examples you still want to market time, number one, I'm not going to be your financial advisor, but number two, think about it. Go out and get a cup of coffee and understand what you're doing. All right, and I'll see you next time on Financial QB TV.